Hello.
Actually, you're muted, but we're gonna figure this one out. Okay, that's because we have 2 extra minutes. So great, yep. That's because I was trying to play it off my phone really quickly. Tyler, of course, wanted Guns N' Roses. Tyler, just say hi.
Hello, everybody. Great.
Still muted, but I'll let you know.
Okay,
We got
good.
this one, guys. All right, well, since you can hear me, I'll be obnoxious. You can hear Tyler? We can hear him? Okay, great. Well then, Tyler, I guess we can hear you.
Oh,
Okay.
that's great.
Tyler, say hi one more time.
Yeah, hello, everybody. For some reason,
all right, I guess it's just me. Okay, so as an overview, everybody, thank you so much for joining us today. So this is a Consensio webinar. It's the first one that we're doing. We hope to have plenty more. So just as an overview, as you guys know, right, this is going to be 3 one-hour segments, okay, and they're going to consist of the first hour. So 80% of the potential of moving averages are underutilized, even by expert technicians. So how are they used? How should they be used? Simple versus exponential. Why 2 moving averages? Why 3? Why more? What is the essence of a moving average? And what does it tell you? What information does it represent? And examples. Second hour. What is a trend? Short-term, intermediate, long-term? What does each mean? How do you recognize them? What technical tools indicate a weakening or strengthening trend? Are trend changes predictable? Always, sometimes, never. Do the duration and amplitudes of trends vary with each asset class, within asset classes? And the third hour, Consensio. So the art of understanding and reacting to incremental trend shifts using multiple moving averages of varying durations. That's right, many examples from 2007 to 2008, stock and bond markets, crypto, 2017, 2018 stock markets, 2009 stock markets, bottoms and tops in precious metals, emerging markets, and junk bonds. Okay, so how the program's gonna work, and then I will pass it off to Tyler very quickly because that's who you guys came to hear, is we're gonna go straight each one. So first segment, second segment, third segment, each hour. And then at the very end, I'm gonna take your question and answers. Hello, little Ty. And so, without further ado, Ty.
Terrific. Thank you very much. Is the volume okay, everybody? Great. This is really a thrill for Leah and me, mainly because Leah came up with this idea all by herself all the way back in January, and we didn't really get started until February. And one of the things that we wanted to try to do is we wanted to try to marry the crypto world and Bitcoin in particular with traditional investment management tools. And a shout has to go out to Tone Vase, because Leah and I would not have had the interest in this space from right now the 91 participants that are on, but a number of followers that we were lucky enough to be able to team up with Tone Vase. And he was generous enough to share huge amounts of knowledge with us. So if Tone is on, thank you very much. We owe an awful lot to you. The next thing is we owe a tremendous amount to the people on Twitter and YouTube that have taken the time to listen. And I get a kick out of the fact that a lot of you love to put our YouTube on 2x, meaning the speed with which we go through it, because as you all know, I speak very slowly sometimes. And I try to choose my words and my conclusions very, very carefully. So if anybody wants to play this back, just you can speed it up to 2x. 3 hours is not enough time. It's not nearly enough time to cover what we're going to cover today. So I'm going to go through parts of this very, very quickly. But I wanted to spend a little time just talking about the fact we're going to talk about one technical tool today, which is, we call it Consensio, which is a fancy way of saying silly moving averages that everybody in the world has used going all the way back to 1920s. However, I recognized fairly early how underutilized they really were. Now, what Leah just told everybody is that this first part, we're going to be talking about moving averages and lines and charts. And we're not going to really get too deeply into Consensio until we get to the end of this first hour. We'll take short breaks between the hours, just a couple of minutes each, so people can get up and stretch, and I can do the same thing. But this is going to be pretty nonstop. If you don't have pencil or pen and paper, this is the time to get it. There's going to be an awful lot of detail, and I know that it will be helpful not just right now with what's going on in the marketplace, but very hopefully for years and years to come, because it's one of the most powerful tools I have found in recognizing trend changes. And that's what we're going to talk about in the second hour. What is a trend? And what does it really mean? So before I get into those kind of things, I just wanted to hold up a couple of things. This is a book. It's actually a part of what Edson Gould wrote back in the 1970s in his group called Findings and Forecasts. And this is called The Vital Anatomy. This was written before many of you were born. And I could show you the same thing from the 1920s and the 1930s and the 1940s. People that recognized what really moves markets. And one of the best ever is this gentleman, Edson Gould, Edson-Gould. You can write that down and then Google him. And what I wanted to do is just read something. I've got 4 little pamphlets here that I pulled randomly out of a box that's in my office that has another 150 of these kind of things. And then I've got another 100 boxes full of these, plus my own research going back many, many, many years. Unfortunately, I just moved not too long ago, and so they're still in boxes, including a lot of work on hyperwaves. So I'm also grateful for a number of the people that are listening right now who come from our hyperwave research group. I had nothing to do with forming that group. They did it themselves under the leadership of a half a dozen brilliant people. We now have pushing 40 people in the group. And what they're doing is constantly looking for hyperwaves around the world. Many of them are doing it so they can trade them, but many of them are doing it for the analytics involved. And that saves me and everyone else a lot of time. And I'm very, very appreciative of that group. Okay, this is back in the mid-1970s, what Edson Gould said about his whole structure. I will just read you a very quick profile. You'll find a lot more if you Google it, but although formally educated as an engineer, Edson Gould found his way to Wall Street at an early age. His association with John Moody, Moody's Investor Service, which of course is still one of the big 3 services today in the bond world, back in the 1920s and 30s, afforded him valuable training as a security analyst, account executive, editor of Moody's Stock Survey and Moody's Bond Survey, and head of the economics department. As former senior research partner at Arthur Wiesenberger and Company and investment committee chairman of Nuveen Corporation, Mr. Gould is one of Wall Street's pioneer technical security analysts, having put together the first glamour average back in 1960, at that time encompassing such little or relatively unknown stocks as Xerox, Syntex, Polaroid, and IBM. Articles by, interviews with, and quotes from Mr. Gould recently appeared in such leading financial publications as Wall Street Journal, Barron's Business Week, New York Times, et cetera, et cetera. Okay, so he's the real deal. But I hope you caught the bit about technical analysis. The reason I glommed onto him back in the 70s is because he married fundamental analysis that had gone back to the 1920s with his work in the 1950s, 60s, and 70s. And here is his group called Findings and Forecasts. Here is their philosophy. And this is a lead in to our first two parts, one on moving averages and one on trends. He says, it has been said, making money in the stock market is not that difficult, but keeping what you've made is. It is our firm belief that most investors give back their stock market profits time and time again by making a continuing mistake, ignoring the importance of overall stock market trends, especially primary, intermediate, and long-term trend reversals. Now, this is before John Bogle and Vanguard and Wall Street begin telling people what you want to do is buy and hold, because eventually it's going to work out. And I've never bought into that from when I first began in the mid-1970s, and that's why I began following people like this. This little pamphlet is one that I picked up in the early 1970s called the Cherry Book. And the reason I bring it up is because it's so unusual, and it got me started in what I've done for the last 40 years. The Cherry Book is the insider's guide to intrinsic value of common silver coins of the world at silver bullion prices of $2.50 to $5 per troy ounce. Well, I came across this in the very early 1970s. Remember, 1971 is when Richard Nixon closed the gold window. Silver was tied to gold, and gold was pegged at $35 an ounce. And what people did not realize in the early 70s, as gold went from $35 an ounce to up to $200 very quickly, and then pulled back and then ran up to $800 9 years later, that silver was doing the same thing, running from $1.65 to $2, and then finally up to $40, and then all the way back down. Why do I say all the way back down? Well, you know what I have said about hyperwaves. Both gold and silver turned out to be in a hyperwave. But I got very interested in silver and silver coins in 1971, 72, 73, and 74 because of this little pamphlet. You can turn in this pamphlet to any random page. This is Honduras between 1931 and 1967 with all their coinage. And the next page is Sweden, and the next page is Canada. All around the world, taking the silver coins and telling you at what point, $2.50, 60 cents, 70 cents, that the price of the coin was worth less than the silver in the coin. And I thought, wow, this is great, because I'm beginning to see that prices of gold and silver are going to go a lot higher, and I'll bet not a whole lot of people around the world know that the currency, this change in their pocket, is worth more if they don't spend it on anything. And so I went into business while I was in the Coast Guard with the captain of the port. I was the chief executive officer in Honolulu. And what the two of us did is we ran ads in the newspapers telling everybody, if you've got silver dimes, quarters, half dollars, silver dollars, bring them to us, or we'll come and we'll pick them up, and we'll give you 1.5 times the value, face value of your coins. What we didn't realize is the Japanese that had moved to Hawaii after World War II and in the 50s and 60s, and opened up mom and pop shops, had the inkling that the silver in silver coins someday would be worth a lot. And so many of them, hundreds of them, began putting them in safety deposit box in banks all over Hawaii. And we didn't know that, but all of a sudden our phone was ringing off the hook with people with $100, $500, $1,000, $10,000 worth of dimes, quarters, half dollars that were silver. And so we would walk in and we would pay 1.5 times what they thought it was worth. We had already sold it back in Los Angeles that same morning at 2 times face value. And we did that for 3 years. And I used that money, I had no money at the time, to buy my first condominium. The reason I point all of that out is, without going into a lot of detail, but we found that large institutions, banks, currency exchanges in airports, casinos in Las Vegas, didn't realize the value of all of their bags of silver coins. So we could walk in and we could buy them for a lot less, 25% less, and still make a huge profit on it. And that lasted until everyone caught on with what was going on. And then, of course, that was dead. So keeping your minds open at all times when you start dealing in assets will lead you to be able to recognize things that even people in the business don't recognize. And I talk specifically about that relative to what Wall Street has told you is true, without you asking the question, why are they telling me that? Or why a hedge fund manager coming on to CNBC and talking something that they believe in. You have to ask the question, why are they telling me that and this audience that? So you have to be very discriminating about what you assume to be true. And the most obvious things very often are overlooked. This little pamphlet called The Long-Term Trend of Volume was written by my partner back in the late 1980s. I had a company called Cannon Block Carre that I've talked about before. We were in Boston and we studied mutual funds. Why? Because nobody was studying mutual funds. The only thing you could ever find out about mutual funds, and I talked about this in an earlier vlog, is what did they do last year and 3 years ago and 5 years ago, but nobody analyzed them. Why were they doing that relative to indexes and other mutual funds? And so we put together a company and that's all we did, but we did it also on a technical basis. And this gentleman joined us. His name was Walter Stone. He's one of the best technical analysts I've ever met. I was privileged to work with him for 6 years, but this whole booklet goes into decade by decade, the volume relative to the Dow Jones Industrial Average, going all the way back to the late 1800s. And he did everything by hand until computers came along. He went crazy when the first Macs came out. And because all of a sudden he could do all these analytics. Up till that time, every day since the 1950s, in other words, 25 years, he kept all of his technical charts by hand, pencil and paper at the end of every day's trading on Wall Street. And we're not talking about just the price. We're talking about 50 different indicators, several of which he had invented, many of which had to do with volume. So I began to see and understand how volume actually works. You don't hear about it too much today. Finally, I picked up this one randomly, which is my favorite publication of all times. It's just called Cycles. And it's very difficult to find anybody talking about cycles. This particular one was published back in 1989, but for years and years and years, I received this monthly, looked forward to it because of what it included in it. There's one article that I thought was fascinating about a thing called a 9-year cycle. And in this article on a 9-year cycle, which I hadn't heard before that, nobody talks about now, the person that wrote it listed about 15 different major cycles that have nothing to do with the financial markets. They have to do with things like church membership and sunspots and agriculture and growing cycles and heating and cooling cycles, the things that people throw around today having to do with global warming and all of the rest of it. This is what the article looks like. You can just see some charts. That's a 9-year cycle on the one page. Now, the people that contributed to this, to people in technical analysis, you know all of the names. I'm just going to turn to the front because the board of directors, the chairman is a fellow back then by the name of Peter Borish. Peter Borish, most people don't know, was Paul Tudor Jones's chief researcher at his hedge fund for years. And I got a call from Peter Borish. I didn't know who Peter Borish was until he referred me to this magazine that I'd been reading for years before that. And he called me up because he saw an article about hyperwave that was written in the San Francisco Chronicle and made the front page of the daily newspaper with a chart of a hyperwave, which was back in 1989, which is one of the only times I'd ever talked about hyperwaves publicly. But I was flipping through this one on my way over here, just looking at the names: Robert Prechter, Jim Tillman, Ray Merriman, Peter Eliades. Peter Eliades, for those of you who don't know, is one of the eminent, with an E, practitioners of technical analysis, has been slightly longer than I have. And he spent a lot of time on television out in Southern California talking about a thing called speed resistance lines. And speed resistance lines, going through Edson Gould's book on my way over here, I was just flipping through it. And back 10 years before, 15 years before this, Edson Gould was talking about speed resistance lines. Most people don't know what they are and don't use them today. Okay, too much time, but it's important for you to hear me saying, as you have in many of my vlogs, that all of these things tie together. We're going to talk about one of them today, and we're going to do it by going directly to this thing that I call Consensio. So I am going to share with you this picture. That is because I am the president of Lucid Investment Strategies. And now I want to share with you this picture again, because I am still president of Lucid Investment Strategies. Now, somehow, what I need to do, and here comes my assistant who knows these things where I do not. And there we have her. Thank you. That's my son, Tyler, who runs verypossible.com with Leah's brother. And that's backstory that some of you know, and someday I will tell it to everybody, but that's how we got into this whole thing. Okay. You've seen this chart before, and this is the beginning of what we want to talk about today, which is what is a moving average and how does it work and what does Consensio mean? And what I'd like to do is I would like to have you mentally begin picturing some things. First of all, I want you to think of every chart you've ever seen having to do with stocks, bonds, ETFs, commodities. They all have two similar aspects to them. One is an x-axis and one is a y-axis. Along the bottom of the chart is almost always time. And along one side or the other is almost always price. Now, you learned in simple math classes that that is only one quadrant of reality, and it's the plus quadrant. In other words, if you are looking at a full graphic where across the bottom is one axis and my other arm is the other axis, in the upper right-hand quadrant are pluses. You go from 0 in the middle where the two lines cross, and you go up either price or it could be anything else, but along the bottom axis, you go from 0 out to some number, which is time. And that's where in the financial world, we do all of our plotting. There's huge implications to that fact. One of them is that everything moves from the 0 line in the middle or on our quadrant, the plus quadrant. From the bottom left corner, it always moves to the right. Why? Because time goes by. And that means you can do certain things plotting time against price in that quadrant, but you can never get the line to go completely horizontal or flat over time unless price does not change. That flat line becomes what is called a trend line. And what you need to understand in this first hour is that all lines on a financial chart are not equal. The strongest lines on a financial chart are horizontal. If price is changing over time, you will get an angular line. And that angular line is not as strong as the horizontal line. And what becomes important is the angle of that angular line can only move through certain degrees. It can never go up to 180 degrees relative to the timeline. And of course, it can never go to 181 degrees because that would mean you are going backwards in time. So as you always move from the left-hand side lower of a chart across the chart over time, you are limited into what those lines can do, what price can do. We won't talk about the other three quadrants because they're theoretical and it works for mathematicians. It also works in the practical world that if you are going across time and you've got X amount of dollars, you can move into the lower right quadrant by losing money. You can go below zero. You can't do that in the investment market because if an asset drops in price down through the zero line, it's out of business. You can do it with your budget and you can do it using credit, but an asset can't do it. If a corporation's price drops to zero, that corporation is out of business and therefore you don't have to look at it. Simple observations, but they have tremendous meaning when you look at charts. Particularly when you start doing things to those lines. I'm not going to talk hyperwave today. Those of you who have looked into hyperwave through our vlogs or heard me talking about it knows that what happens is you start out with what is called a phase one line, which is a horizontal line. And the reason it's so important in hyperwave is because it's the most powerful line because it's horizontal and that restricts price over many, many months, quarters, or years before anything happens. And it's also the thing that attracts price back to it at the end of a hyperwave. All right. But a horizontal line does a lot of other things when you look at things like Fibonacci numbers. Fibonacci lines are horizontal. And I've already said that those lines are more powerful than angular lines, which can be trend lines. Most trend lines are angular. They move from left to right, but they can move from high to low or from low to high. If they rest somewhere in between high to low or low to high, they become horizontal. And that's why those of you that have listened to us about Bitcoin, we identified very early two very important horizontal lines. One was at 10,100 on Bitcoin price, and the other was on 11,100 on Bitcoin price. Okay, back to screen share, hopefully, without me bringing up the presidential picture. Boom. All right. What we're going to look at today are, in this particular case, only two moving averages in price. Now, I've shown this before. We did an entire vlog on it, but I want to go through it very quickly to show you why I came up with this thing called Consensio. Consensio, as Leah had talked about before, means agreement in Latin. And what we're looking for is we're looking for prices, moving averages that come together or agree with each other at a point in time. and I'll explain why that is. But for now, let's just quickly go through what we're looking at. We're looking at a short-term moving average, a long-term moving average, and price. The short-term moving average, unfortunately, is a light blue color, and so it gets lost as we come down, and you can't see it here, and then it goes up. But you can picture it mentally, and I'd much rather you picture it mentally than looking at the picture. What you're looking at is what is called a sine wave. And that simply means that if you graph the sine in trigonometry, it has a wave-like function to it, in which if you draw a horizontal line at the 60 level here, you start at one point, you move up at a certain percentage rate, you come the same percentage below that midline, and then you get back to the midline. You keep repeating that forever. I chose this as a way of explaining Consensio because it's the best way to get into what we call the subconditions of Consensio. And the subconditions of Consensio are made up of A, which is what you're looking at here, and this is a bull market. When you are in A, you are in a bull market in Bitcoin, in the US stock market, in gold prices, in anything that anyone studies where you're going from left to right against an X and a Y axis with price on one side and time at the bottom. That's a bull market. That can last for many years. We've been in a bull market, the longest in history, right up through today. We are still in that bull market. When we talk about Bitcoin, we know that Bitcoin did this also. It took it 10 years to get to where it was going. Along the way, we had a couple of bull bear cycles, then a very big bull cycle, and now a very big bear cycle. That doesn't matter to this analysis. And what certainly doesn't matter is the name of whatever it is you're looking at. They're all exactly the same. I'm sorry for those of you who continue to believe that Bitcoin is something other than the other 200,000 asset classes and sub-asset classes that all technical analysis works with. It is simply another one. Okay, that's condition A. Price, the blue line, is above the intermediate term, which is above the long term, and the short term is above the long term. They're all going up together. This on the far side, and we'll get to it in a very quick second, is another bull market. So we're looking at two bull markets, in between which is a bear market, in between which there is all of this confusion there and down here. What Consensio attempts to do is get you out of a bull market long before the bear market has started, and to get you into the next bull market, but not long after a bear market has ended. And I'll explain why I just said that as we go through this over the next 3 hours. Okay, what I would like to do now is take a look at subcondition B. Subcondition B must always occur before you go from a bull to a bear market. You can't get into a bear market without doing subcondition B. And subcondition B simply means the price is the same as the short-term moving average, right here. This blue line that you can't see, and the price are at the same point at the same time. In the popular vernacular, price is cutting through or crossing the blue line. That is B. You can't go to C without going through B. What is C? C is price is now below the short-term moving average. It was on it, it's now below it. Price is still above the long-term moving average, and the short-term moving average is still above the long-term moving average. So just at one point in time, you had that point A. Now you're in point B and then point C. Point B, they touch. Point C, they cross. And then point D. You notice that I am not talking about time periods. I haven't told you the length of the moving averages. They don't matter until you have picked your asset and until you know, are you a gambler, a speculator, or an investor? You can be all of those things, but not if you're using Consensio for making a decision unless you predetermine how long you intend to hold this particular asset. We will get into that in a lot of detail in the second part when we talk about trends. What I want you to picture is what this is telling you, the story it is telling you, referring back to what Edson Gould said. If you remember what he said that everybody can make money investing, but very, very few people can hold on to it. And the reason is they don't understand the difference between short, intermediate, and long-term trends. What I'm now showing you is a way, very mechanical, that you can absolutely identify the trend, short, intermediate, or long, and move from a bull market out of what you were in a step-by-step fashion and protect yourself from what Edson Gould, after 40 years, realized was the biggest problem with investors. Subcondition D, the price is below the short-term moving average. We've seen this over and over again in the last 2 weeks. Many of my clients, our consulting clients, have been asking, doesn't that mean I should be taking something off the table? And the answer is yes. But if 10 people ask me that question on the same day, I might go yes, yes, no, 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 yes, yes, no, yes, no, yes. Because it is dependent on what you as an individual are doing with that asset. Are you jumping in and out of it? Are you holding it throughout a long-term trend? And that has to do with the time periods that we're going to talk about in great detail later. Okay, price is the same as the long-term moving average now. In other words, the price has been coming down, the short-term moving average is flattened out, and the price has now touched the long-term moving average. And on, without looking at all of them, because we've got lots more to cover. Condition E, F, G, and what is going on in G now compared to what we were looking at A. Price is below the short-term moving average, price is below the long-term moving average, and the short-term moving average is now below the long-term moving average. Notice that the long-term moving average has only at the beginning rolled over and started turning down. Each of the steps that we're talking about now have to follow and or precede the steps in front of them. Now we've just run from all the way up here on the chart at whatever price, depending on the length of your moving averages, you wanted to get out of this uptrend. You are out back on subcondition G. And look what happens in subcondition H. You're in a bear market all the way down until that bear market begins to change. And finally, in this idealized way of looking at what Consensio is attempting to achieve, we begin up the other side until everything is crossed over and you're back out of a bear market and into a bull market. Now, that's all we're going to do with those lines at this point. Those of you who have gone back and looked at the vlogs, and thank you for doing that. We get a number of people that call us and said, we didn't want to contact you until we had watched all of your vlogs at least 2 or 3 times. And that is music to my ears. We have been more than happy to make those available to as many people as wanted to for free. And now we're going to start going into in-depth on some of the concepts we've talked about. Not because we are money hungry, but it's the practical way for monetizing what Leah spends so much of her time doing without getting any sort of remuneration. But more importantly than that, a 3-hour, I can't do a 3-hour vlog just on Consensio. This one could go 10 hours on Consensio. I think we've been able to get it down short enough that you will know everything you need to know about Consensio. And we've got another 6 or 7 of these planned between now and the end of the year on a number of different subjects. One of them, unfortunately, is not going to be hyperwave, because we are going to introduce that as a tip of our hats, our collective hats, to Tone Vase. We will do that during his January conference that he's starting for the first time this year. And that will be the first time in 20 some odd years I've made it public in a general way. And I think that's the right place for us to do it. But all of these other topics that we're going to be talking about in great detail between now and then, I think you're going to find very interesting. Okay, we are already 12 minutes away from the end of the first hour, where we have talked about perspective, first of all. One of the things about going on TradingView or Stock Charts or Bitcoin Wisdom or a lot of places you can go at Fidelity or E-Trade to look at price, you can click a button and a technical indicator will pop up against what you're looking at. And some of you have spent a lot of time trying to understand what those indicators are. What I wanted to give you a little bit of a perspective on is that each of these indicators have been built on the backs of other indicators going all the way back close to 100 years. And each thing, the Gann angles, if you look on all these charting services, the Elliott waves, all of those came in the 1930s and 40s. Charles Dow came up with the Dow theory in the late 1800s. Roger Babson has a brilliant book that he wrote along with 4 or 5 other books in the 1920s, Babson of Babson College, but of many, many other things, that has charts in great detail the way Edson Gould had charts in what you looked at from the 1970s. He was doing that back in the 20s. It's difficult for us today to look at something by pressing a button and overlaying something that someone else did by hand over years and years, and then someone else came along. Let me give you an example in terms of the sequential trading system that Tone Vays has changed off of the TD trading system that Tom DeMark changed off of the original, which came from Larry Williams back in the 1970s. And along the way, there were improvements made. I don't think anyone improved it the way Tone Vays has, because he's added other things to it. Now, you can either spend time doing that yourself, and many of you are doing that. Many of the listeners, we've got 100 people on right now. Many of you are very interested in understanding these and spend more time than I do looking at these technical indicators, not only intellectually and academically, but so they can figure out how to manage their own money. And they're using a lot of these techniques to do it, some very, very successfully. And that's what I hope everybody gets out of this. Those of you who started listening to us only because of Bitcoin and crypto, which is how we got into this, but many of you are a lot more experienced than a lot of the people who are only in the crypto space. Not because you're smarter or more intelligent, but basically because you're older and you've lived through things like 06, 07, 08, some of you through 2001, 2, and 3, in which you had money on the line and only realized after the fact that Edson Gould was right. And if you didn't know what Edson Gould said, or you hadn't experienced it before, such as in 1987, the stock market crash, or after 17 years of the stock market not going anywhere from 1965 to 1982, you didn't get in at the beginning of 83 or 84 or 85 or 86. And you didn't get in at the beginning of the 90s. And you didn't get in until 95, 96, 97 had proved to be the 3 biggest years in a row in stock market history. And now you read it everywhere and everyone was talking about it. So you got in right before the stock market crash, the dot-com bubble crash in 2000. And back and forth throughout time in your experience. What we found with people in the crypto community is they tended to be much younger, got very excited about this very, very exciting asset class, but couldn't wrap their heads around the fact that all these traditional things that Bitcoin was standing against and attempting to improve upon was actually, many of them, going to affect Bitcoin as another asset class. And we find ourselves in the middle of that right now. Okay, so the reason I'm going through all of that is I've just outlined to you one system called Consensio that you can't really grasp what it's doing just by looking at the wavy lines. It's important that I have stressed that in this sine wave that I have shown, that had from A to M to go through a whole cycle, step by step, you will almost never find that in the real world. It's simply an artificial construct that I came up with to show how you need to think about a trend change. As soon as you've added a third moving average to the two that you just looked at in an ideal situation, you go from A, B, C, D, E, F, G, H, I, J, K, L, M, 13 iterations in the perfect world, up to many, many times that in the real world. And early on, when we presented Consensio for the first time, I challenged everybody, add one more line, which we'll call an intermediate term moving average. What we just looked at was just price, short term and long term. If you add something between those two moving averages, I asked you to calculate, if you could, the number of iterations it would take to understand what was going on from between a bull market through a bear market and back to a bull market. And many of you guessed 35, 36. Some came closer at a couple of hundred. A couple of people got up as high as 400 or 500. We found that there was well over 1,000 different iterations just by adding that one line. And if you go from a perfect sine wave construction, which almost never occurs in the real world, to the real world where each part of that sine wave can be extended, can drop sharply, can move to the left sharply, never to the right, because you can't go back in time. But it always moves from left to right, but there's still 1,000 variations. So the way you marry this confusion from simplicity to what we've just talked about to certainty, which we will get into the second hour when we start talking about what is a trend. What does it really mean? We throw the terms around all the time. So with that, we're going to take a break. We've got a couple of minutes before the hour is up. What we're going to do is we're not taking questions during this 3-hour period, but we've got 45 minutes or an hour after the 3 hours are over. And Leah is working very diligently behind the scenes to